This is episode 284 of Zen and the Art of Real Estate Investing with my guest, Mike Zlotnik. Mike is the CEO of Tempo Family of Funds and Syndications. He's been a fund manager since 2009. He's been investing in real estate since 2000. He's also the author of the book, How to Choose a Smart Real Estate Investment Fund. And he has his own podcast, Big Mike Fund. Mike, welcome to the show.
Thank you very much, Jonathan. Pleasure to be here.
Yeah, I'm excited to talk to you and get your background because everybody's always so different. When was the first time that real estate kind of started to, play a role in your life where you thought, hey, this is going to be something later? Because I know you started in software.
Yeah, 2000, when I bought my first apartment here in New York City with primary residence. That's what they say. The first investment should always be your home. Some people choose stocks and mutual funds, but we saved up and bought the first apartment for cash. As simple as that.
Okay. Yeah. Well, why, when you did that then, I know you weren't thinking as a real estate investor then, but why did you decide to go cash on your first purchase? I grew up as a cash investor with a dad who was a cash investor. So I kind of knew it that way. But why did you choose to do that in 2000?
Good deal. You need cash. That's simple. So when I got a good deal short window, you have to close this cash, then you can refinance.
Yeah, that's fair enough. And that also goes to the tempo of the market. New York City, you're going to have, at least at that time, there's going to be a lot of bids, less opportunity. So the strong offers are going to be cash, quick close, not a lot of being a pain on the inspections and everything.
Exactly. Yeah.
Yeah. So once you bought that, did you start to see the scale of real estate, and how did you kind of transition to saying, hey, maybe software is not it. Maybe it's really real estate that's going to take me to where I want to go.
Yeah, that journey took only 9 years, very short window. I was passive for 9 years while maintaining the technology career and then switch. But after I bought one, I bought a package of 8. And I kind of realized it's all awesome, but you don't cash flow. So when you buy deep, you basically buy future appreciation. But New York City, your cash flow is very light.
Yeah.
Right? So the bottom line is it's a great appreciation market. But it's not a great cash flow market. So it took me 9 years of just kind of thinking about what I really like to come to the conclusion. And 2009 was the time to switch.
Yeah.
For a lot of professionals, it's difficult to make the transition because you have a great job, you have a great paycheck, and it takes a little bit of courage and circumstances to make the move.
Part of your philosophy over your career has always been networking and real focus on masterminds and building these relationships. Explain to everybody out there who's not as focused on those why it's so important. As we know, as you get up into commercial, everything is relationship based. But even in residential, the better relationships you have, the more deals you make and the more secure your deals will be, like you were saying.
Sure. So masterminds don't guarantee success. It's a great platform for a few things. One is educational. You learn best practices, who is doing what in the industry today, how they're doing it, what's working, what's not. It's changing over time. Next is just networking. You get to connect with people. And in investment business, there's this phrase I use all the time. It's always in my head. You can't invest with me until you establish this, and I cannot invest with you until I establish this. And it's called know, like, and trust. Right? So part of the mastermind, they need to understand who you are, how you think, what kind of deals you do. And it takes time to build these relationships. But you got to start somewhere, and you start with know, like, and trust. Then you do some underwriting, whether it's debt or equity. So these communities are wonderful to build these relationships, to get you the right thinking, the right process, the right education. And over time, you get better, you learn more, and we all evolve through that process.
Yeah, and I've always said that the mastermind content is generally going to be okay. You're going to get that pretty much anywhere. It's not like someone's invented new content in a mastermind. Maybe if you're in short-term rentals, it's more specific, but it's not like they reinvented the wheel. But the people in the room with the same buy-in as you or the same motivation to get there are the things that could turn out to be partners for years. But as you said, it's part of networking to see who is a better fit for you, because not every person out there, just because they're in the mastermind, means they're going to be a great fit.
And I love this comment. People evolve and they grow and they change. I've had situations where first I loaned to folks for years on their fix and flips, and years down the road, they reached out, said, I made so much money. Can I invest in the deals? What are you working on? What can I invest in? So we've had a lot of that evolution, but you build relationships with successful business people. And as you do that, you'll learn on the way, and you connect on the way through the journey.
So at Tempo, what's your percentage in terms of funds and syndication? Do you prefer one to the other? Because building funds and building either just a one property syndication or even a multi is a little bit different.
So it varies. We're probably 50-50 today, but I would say that there's a significant recent trend to do one-off deals now versus funds. And some people have expressed interest in funds for their own diversification
Yeah.
purposes. But honestly, it's a lot easier to explain syndication, a lot easier to understand a syndication one-off deal. You got specific location, you got specific strategy, specific leverage, specific cash flow, etc. So today, I would say we are heavily focused on one-off deals, simply because we want to be very confident that we're doing a great deal, not a good deal, but a great deal, and be able to tell the story to our investors. This is a great deal, and this is why. So for some folks reach out and still want to talk about funds. That's wonderful. But my personal preference, I got a lot more excited about deals because it's just, there's more excitement about it. Now you have to be mindful that you still need to diversify. The beauty about the funds is diversification, but it's also got drawbacks and curses being in a fund. So I would say today, the more popular topic are one-off deals.
Yeah, I mean, personally, I started investing as an LP only last year, and all four that I'm in are all one-off deals. I feel a little bit more comfortable even with my experience because it's a product, like you said, there's an address, whether it be 50 units or 250 units. I know it's there. I know what the asset is. That's the one thing I can focus on. For me, I haven't invested in funds, not because I haven't seen any good ones. It's just because it's a little bit too open-ended for what I'm looking for with my passive investment, but I can see why both vehicles work. What asset classes are you doing for your syndications? Is it multifamily or more than multifamily?
So that's one of our strengths, that we're very flexible. So at the moment, we see very deep value in multifamily, and we've done some deep value by multifamily today because the market has gone through a cycle and valuations have been reset, right? We're also doing a deal right now in open air shopping. That's been a
Oh,
contrarian play for
yeah,
many years. And the fear was Amazon was going to eat, or e-commerce was going to eat their lunch. But the crazy part is this: open air shopping has actually thrived, and you see this everywhere all day long. I just came. I drove. I have family in Rochester, New York, and I was in Rochester, New York. It's a long drive from New York City last week, and literally drove. And I look at the marketplace mall over there. It's an enclosed mall, and that mall is dead. And then you just basically drive 5 minutes away, literally 5 minutes away, open air shopping plazas next door. They are thriving. They're
yeah.
busy. They're loaded. It's kind of amazing. There's retail and there's retail. So a lot of people still love outdoor experiences. Service-oriented experiential retail continues to do well. And we find phenomenal deals in these type of deals because you could buy very deep. You could buy at a high cap rate. Certain asset classes, just very difficult to find deals. I just give you another example. I looked quite a bit recently into self-storage, and we love self-storage, but we haven't done that much. For some strange reason, it still trades a very low cap rate. Prices are high. I don't know what people are thinking about. They're still buying at a negative spread between the cap rate, what they're paying for the
Hmm.
property, and the interest rate on their mortgage. And I look at these deals and I'm like, okay, that's wonderful, but you're not making any money on the buy. There's no discount. There's no, you basically are hoping you're going to be able to push rents higher.
What are you seeing though in terms of your investors? I know you build this up over relationships, but when it comes to new referrals, what's the main reason they're coming to get into things that are clearly passive?
Yeah, it's a great question. And there's no right or wrong. We got plenty of high tech people, doctors and other ones in different
Yeah.
ages. There's some people who are looking to retire and get more predictable income, part of that theory. I've had discussions with people who wanted to actually take on less risk. And the bottom line, people go into real estate primarily because of predictability, but not to kid anyone, there's risk. There's risk in everything. Just to be very, very simple and clear about it. So it varies. The different circumstances and different conversations. Some of our existing investors looking for new deep value buys. So depending on who you're looking at, who you're talking to,